if you happen to be in the UK and you're watching this, unfortunately, this is not for you. This is specifically for people that are living outside the UK. So I'm just telling you that up front, so you don't have to listen to the next 30, 40 minutes of this webinar to find out that it wasn't applicable to you. So the webinar is specifically focused to people that worked in the UK before, paid previous national insurance contributions, and now they're living overseas. Now, I think that the webinar will cover almost all the questions that people asked, but I noticed that some of the questions came from people that are already retired and claiming their state pension. Unfortunately, again, this is not relevant for you. If you're already retired and you're already claiming the state pension, you cannot make any national insurance contributions going forward, I'm afraid. So that's just to give everybody a bit of a head start. I'll just talk you through the agenda. We're going to be going through the facts about what is the state pension, talk about the eligibility requirements for being able to get the state pension, and what the actual state pension entitles you in terms of how much money you'll get. So these are the first things we'll be covering. Then what we're going to do is talk about how you check your national insurance record. Now, I know some of you have already done that. I'm going to be quite brief on that, but it is dead simple, and I'll just be explaining how to access the government gateway system to be able to get in and check your national insurance record. Then we're going to be talking about the voluntary contributions. So as an expat, there's two types of contributions you can pay. There's class 2 and class 3 voluntary contributions. Okay, there are 4 classes in total, but class 1 and class 4 you would not be eligible for. So I'll explain about this. Then we'll talk about how to backdate the contributions and what the changes are that are coming into play from the 31st of July. Okay, so we'll be covering that towards the end once we sort of set the foundation, if you like, on what this is all about. After that, we'll be telling you how you can actually contribute. So I'll go through the form with you on the presentation, show you what to complete there. It's literally a 2-pager. It's dead simple. And then we'll take Q&A. So that's it. Before I plow into the state, who are Herbon Assets? Well, we're an independent financial planning consultancy. We're a group of independent financial advisors that are based around the world. We were established in Dubai in 1998, and since then we've grown to having 16 offices in 14 countries. We've got 9 regulatory licenses, including where I am, the Dubai Financial Services Authority license. We've got the UK Financial Conduct Authority license, the European MiFID II license. So these are some of the most heavily regulated jurisdictions in the world, and we're all fully qualified to give advice in the areas that we're advising our clients on. Now, I've listed some of those areas below, and if anyone has any requirements and they'd like to discuss these later on, they can discuss them with their local advisor, or obviously you can get in touch with me if you're here in the UAE. I'd be very happy to help you. But there's a whole list of other areas of financial planning that we work on. Now, one thing that I can say is that we've got over 20,000 clients, but we're actually, in our industry, one of the highest ranking on Trustpilot. So we've got over 2,000 positive reviews on Trustpilot. We've just surpassed that in the last few months. So this is something we're extremely proud of. And client service and developing long-term relationships with our customers is something that's paramount for us. Now, who am I? I'm Stephen James Mitchell is my full name. I'm an MBA. I've also got an investment advice diploma under the UK financial services regulations and qualifications. I've also got what's called the International Certificate in Wealth Management. I've trained as operated as a wealth manager offshore now for 15 years, actually coming into the 16th year in 2023. Long time that I've helped a lot of my clients actually through their whole offshore career, and then repatriation or moving off to Thailand or wherever it is that they wanted to retire, help them, save, help them get their kids through to university and sorts of other different things. So I'm very proud and happy to be working in this industry. It's a very rewarding industry, but at the same time, I've got a great deal of expertise and I'm fully certified to give the information that I'm covering here. Now, my areas of specialty, if you like, is the UK tax and pension. So if you have UK tax questions, we can discuss them offline. And anything related to other UK pensions, offshore pensions, pension transfers, all of these type of things I can help you with. So let's move on to talk about the state pension and what we're here to discuss today. Now, a lot of people don't realize, but the state pension is not something that you're saving for your personal retirement. It's not like you're paying HMRC and they're keeping that money for you and allocating it for your. What you pay in your national insurance contributions today actually security benefits and state pension today. So essentially, whatever money you is actually going back out the door to pay people that are claiming the state pension at the moment. So are actually qualifying years of entitlement to a state pension in the future. Now, you can claim the state from age 66 if you're going to retire before 2026. If you're retiring after that, which I guess most of you probably are if you're on this call tonight, your state pension age will be 67. So you would have to reach 67 before you can start claiming the state pension. There is talk of that going up to 68 in 2044. So if you're young and you've still got quite a long working life ahead of you, it may be that the retirement age then, as far as the state pension is concerned, is 1 year higher. But then people are living for longer than they ever have done before, and people are living healthier than they ever have done before. And because of the aging population in the Western world, it's likely a lot of people will have to work longer than perhaps they would have been able to in the past, in the days of final salary pension schemes and working for your same employer for your whole life and all of that sort of thing. So the times have changed an awful lot, but that's just to give you an idea. Now, how much is the state pension? It's in this tax year £203 a week. So it increases every year, and it will increase by either 2.5% or the consumer price index, which is a cost of living index, which is not necessarily accurate, but it's one of the benchmarks they use to calculate this, or the earnings calculator index. So this year, I think it was based on earning increases, but it will be whichever is the greater of the three. The increase was 10.1% this year. It's one of the largest increases in quite a long time, in fact. Now, obviously, when the benefit increases, also the contributions increase with the cost of living. So what you will see is that the state pension will go up the contributions that you need to pay, the voluntary contributions, will increase every year by the same multiplier that they've used to calculate the however, even though we're in the tax year from 2023 to 2024, for people that still apply before the 31st of July, they'll be applying as if they're under the tax year of 2022 to 2023, and therefore the rates you will be slightly lower. Now, let's just talk about the eligibility now. So they changed the state. So basically, for people that will retire after 2026, you're going to be retiring under what's called the new state pension. Now, the new state pension has a few, changes. The most important change, especially for a lot of people that are attending this call, was that you have to have a minimum of 10 years of contributions to get any state pension at all. Now, before these changes came in, you could just get a pro rata amount of state pension based on the 3 years of entitlement that you purchased yourself, 7 years, 8 years, whatever. That's no longer the case. So if you check your national insurance record, and we'll look at how we can do that in a minute, if you have less than 10 years of contributions and you don't pay any more contributions between now and retirement, you won't get anything whatsoever. And this is a big in the UK for a number of years, but they're not from the UK. And we've got loads of people from India, Pakistan, the Middle East, and that sort of thing, where I am in Dubai, that worked in the UK, especially in areas like the National Health Service, and they worked there for 7, 8, 9 years. They paid a lot of national insurance contributions, but if they don't top up to 10 years, they won't ever get any benefit from all of those contributions that they've made. So it's essential, if you want to make sure you get the benefit, you get to a minimum of 10 years. Now, the other change that came into play with the new state pension is that they increased the number of working years that you have to pay in your lifetime from 30 years up to 35 years. Now, actually, there's some nations in Europe where it says even 42 years. So I think the UK is still fairly, good here. I think most people in their working life can work, top up 35 years. But this is now what we're using to calculation on. So basically, your state will be however many years of entitlement you bought yourself through qualifying years worth of contributions. Okay, it will be that pro rata or out of 35 years. So there's an example I put here for somebody who's made 20 years of contributions. So I'll just run you through this. So the annual state tax year, so if it's in this tax year, it's 10,600. You divide that by 35, because that's the maximum number of years you could have got, and then you times it by 20, which is the number of years that you've actually, and you will arrive at the sum of 6,057. Okay, now just in case you want to do that yourself, there is actually a link here embedded, goes through to Pension Centre website. And there is a thing here where you can forecast your state pension. Okay, so anyone who wants to get their head around that, they can do it using that. But I think the maths are fairly straightforward. So, look, I mean, obviously the state never probably going to be enough for someone to retire on. But the fact that this is government backed for life, and it's always going to increase with cost of living increases, and it's assured. I think it's worthwhile having. Now, why do I think that? And this is the big question that a lot of expats are not aware of. And I was one of them. When I first came out to Dubai, I didn't actually top up my contributions until about 7 years ago. Now, why didn't I? It's because I thought that I would have to pay at the kind of rates that I was paying in the UK. I didn't know about class 2 and class 3 voluntary contributions. No one had explained that to me. And I remembered what I was paying in the UK under PAY. And I was thinking, why on earth would I? People can retire at 67 years old. I'd rather just keep the money and invest it myself and use that for my own retirement and do my own thing. But then someone explained to me how much the state pension voluntary contributions are. And then I had that sort of aha moment. This is an absolute no-brainer. So I'll be coming to that, but this is just to give you a bit of background about how it's all calculated. So any questions so far? I haven't seen anything pop up in the chat. Let me just see if, no, there are. Okay, all right. So let's talk about then sorry, get rid of this. Excuse me. So hang on. Kill this. So let's talk about how are we going to check our national insurance records. So I put the link here. It's embedded in this presentation, which I'll send you tomorrow. And you can just click this and it directly goes through to the page on HMRC website where you can click and you need your government gateway ID. And then you can go ahead and you can get in and check your national insurance record. Okay. So for those of you who have used the gov.uk website before, you're going to have a government gateway ID. You might need to dig through your emails and try and find it's an 11-digit number you need to do to access it. But basically, once you have this government gateway ID, you can check. Now, why might you have it? Well, you need your government gateway ID to renew your passport, to register a birth, to renew your driving license. There's many things, to get the passport for your kid or something. So if you're overseas and you've needed to do any of these transactions in recent years, I think maybe 5-6 years, then you're probably going to have used the gov.uk website. So once you get in, you're going to need to do the security question, and then you'll be able to check your record. Now, the government gateway does require you to answer, I think, 3 security questions, and they'll be about your, let's say, footprint in the UK. Now, for people that have been away a long time, or they've just left and they've left nothing behind, it might be a bit different, and you might not be able to answer all 3 of those questions. And if that's you, don't give up. It's not a problem. The process of paying Class 2 voluntary contributions, which are what we're going to talk about in a moment, is usually a manual process anyway. So you'll have to go through the same process, regardless of whether you've got access to the gov.uk site or not. But it helps if you do have access, so you can check your record. So this is someone's record, just to show you what it looks like. And as you can see, this particular individual had 12 years of contributions, 26 years to contribute, and there's 14 years where they've not paid enough contributions. Okay. Now, if you were to click on any one of these little links, what you'll see is this. So it says this year is not enough. Okay, you need to pay £824.20 by the 5th of April 2026. So this is giving you an indication of a voluntary contribution based on the default option of Class 3 voluntary contributions. Okay, ignore that and just follow me for the moment, and I'll talk about Class 2 contributions, which are a lot less. So let me go on quick scenario before we actually go and check the contributions. So this is a link to this the salarycalculator.co.uk. Okay, there are lots of sites like this, but basically what you can do is type in your salary. So I'll put like just a assumed salary of 60k, this tax year calculates, and what it does, it just tells you what your take-home pay would be and how much tax and how much national insurance you would pay. So if you were in the UK earning 60,000 modest income in I think today's terms, you're going to be getting a taxable income of 47,430. You would need to pay 11,432 in tax and £4,718 in national insurance. And that would buy you 1 year of entitlement, and you need 35 years to get the full state pension. Okay, so you can imagine the cost of this over someone's working life. If they're working in the UK and they're paying their contributions under PAYE, you're really coughing up a lot of money. So bear with me now, and I'll talk you through what you can basically qualify for as an expat. And basically, there are some criteria that you have to meet, but for most expats who are working overseas, regardless of whether you're employed or self-employed, you would probably qualify for the Class 2 voluntary contributions. So for Class 2, you need to have been ordinarily employed or self-employed in the UK, and you can also be on what's called the dole, or the job seekers allowance, directly before you were going, but before you became an expat, and you must have paid a minimum of 3 years of national insurance contributions in your working life. Okay, so let's say you left college and you went to work, and you worked for 4 or 5 years, and then you decided to move overseas. You're going to be eligible for Class 2 as long as you're employed or self-employed overseas. Now, if you didn't pay national insurance contributions, or you are not ordinarily employed or self-employed or on the dole before you came overseas, okay, or you are living overseas but you're not employed or self-employed, then you're going to be eligible to pay the Class 3 voluntary contributions. So by far the most attractive are the Class 2 contributions. So up to April, believe it or not, one full year of contributions would only cost you £163. Okay. Now, just in case you think this is too good to be true, because I did, I put the links to check on gov.uk here. And also, up until recently, we were wondering if they still honour the 2022-2023 annual contributions after the 6th of April 2023, if this deadline. And we also found a memo that says that they will. So essentially, you not only get to pay the post-dated rates, but you also get to pay a rate, which if you compare the UK under the PAYE system, I just showed you that sort of example of a guy who's in the UK part working in your London office or something, and you're over in Dubai where I am, and that guy who's earning 60 grand a year would be paying £4,700 and you are going to be paying £163.80 for exactly the same entitlement. Okay, and believe it or not, even though Class 2 voluntary contributions are the lowest and they're lower than Class 3, Class 2 contributions actually get you more benefits than Class 3, because you're not just actually getting the benefit of having the UK state pension entitlement, you're also getting the benefit of being able to get the dole money and the incapacity benefit. Bereavement allowance is another benefit. So and it makes no logical sense why HMRC have done it this way. I still can't get my head around it, but this is the situation, and we've helped many clients over the years set up to pay their Class 2 voluntary contributions. And if you are a Brit, it's an absolute no-brainer to do this, and I'll explain why in the next slide here. So let's put this into the context of, let's say, some value proposition. Okay, so you £80. What does that mean? Well, that means that in today's money, in 2023-2024 tax year, the state pension would give you £302 per year for life. So each year is worth £302.86 for the rest of your life. So if you survive for 1 year after retirement, you've almost doubled your money. And that's in today's money. If you're not retiring for 10 years or 15 years, then of course that £302 will be a lot more. So this is, I think, the main reason why people should be doing it. It's such a nominal amount of money to be paying for such a huge, let's say, cushion, just in case you need it. And even if you don't need it, I mean, why not have it? It's essentially almost free money. And, it could, I mean, like where I am, that sort of sum of money would probably cover my annual utility bills and fuel costs. So I'd rather have it than not have it. It's really worthwhile, utilizing this. Now, let's talk about why there's a deadline and what's happening at the moment with the rules changing. So for anyone who's not aware, if you wanted to pay missed contributions prior to 2020, you were only able to backdate the past 6 years. So if you left the UK like me in 2007, I wouldn't be able to miss years from today's date before 2016. So I just lose those years forever. That's the situation. Okay. Now, during COVID times, the government temporarily increased this cap, and they allow to go back to 2006. And they were initially going to do it for 1 year, but then they extended it for a further year. And they gave the final deadline as the 6th of April, 2023. And then they were going to go back to the 6-year cap. So that basically means that if somebody has a gap prior to 2016, it will be 2017 now because we're in the next tax year. Okay. Then they will stand they will stand to lose out on being able to top up those contributions forever. Now, what does that mean financially? Well, 10 years of contributions, that would be from 2006 up to 2016, would cost £1,683. That's how much you would have to pay to backdate those contributions. And it will buy you £3,028 a year for life in retirement age, index linked. So it's well worth doing and backing up and not backdate and not missing out on that opportunity if you've got a big gap in your national insurance record. Now, if you haven't got a big gap in your national insurance record, it doesn't really matter. You can still backdate for a smaller gap. And if you have less than 6 years of missed contributions, or you have missed contributions within the last 6 years, should I say, so not if there's less than 6, because if they're pre-2016, 2017 tax year, you stand to lose them. But if they're after that, so let's say you missed 2018, the rules changing will not affect you, other than the fact that after 31st of July, you would have to pay a higher annual contribution. It's going up to £179.40 a year. So it's hardly going to break the bank, but it's still obviously the one of the repercussions of not submitting before the deadline. Okay. So let's talk now about the process of well, actually, just I just want to emphasize the value of this. The 10 years of contributions. If you live 15 years after retirement, the Times actually released an article where they were predicting that people live 20 years after retirement. But actually, you know, the average life expectancy in the UK is 82. So 15 years after retirement is actually realistic here at the moment. That 10 years of contributions is worth an income of £45,000. And it would be more than that, obviously, because it will go up between now and when you retire. And if you retire outside of the UK, depending on where you live, it may still go up. But there are certain countries where it's capped at the date when you draw it. So depending on where you're going to retire, you might not get index-linked state pension benefits after retirement age. And anyone who wants to check, you know, which countries are applicable to get the index linking after retirement and which ones are not, just let me know. It depends. Just let me know where you intend to retire. Okay. Now let's talk about how we apply. So there's actually 2 ways to apply. The easiest way, if you're already registered for self-assessment, is to pay it through your self-assessment. Okay. The only thing you can't do through the self-assessment is actually find out from HMRC how many missed payments you've got. But if you're doing self-assessment, you're going to have a government gateway ID, so you'll be able to check your missed payments anyway. Okay. So self-assessment is one way to do it. Now, for people that have got, let's say, property in the UK they're renting out and things like that, then this will be an option for you. Okay. And if you're not registered, if you've got property in the UK and you're not registered as an overseas landlord and you're getting your tax deducted by your agent at source, you need to talk to us, because we can help you get that paid out gross, and then you do self-assessment and probably pay a lot less. Okay, so that's one of the things I help many clients with. Now, if you're not, then you need to basically download this form, CF83. It's part of a longer form called an NI38, which pertains to all of the different criteria about insurance contributions abroad. But I put the link to go directly to the CF83 form because most of what's in the NI 38 form is not going to be relevant. And if it is, of course, we can tell you, but I just wanted to show you how simple this form is to complete. It's literally a 2-pager. I'll talk to you about how to complete it in just a moment. So I've just had a question here about if someone's going to retire in Thailand, whether the index linking after retirement is going to happen. And the answer is no. So Thailand at the moment, I believe, is negotiating some kind of treaty on this, but they don't have it. Most of the EU nations or EEA nations have it. I think most of the Commonwealth countries have it. Okay, but for instance, the UAE, if I retire here, I'm not going to get any indexing. Okay, but it also it raises the answer to another question which was asked pre-session as to whether or not the state, or if they never return to the UK, and the answer is it definitely is. Okay, so I was actually helping an Indian gentleman yesterday who's doing this as we speak. He worked for the NHS in the UK for 21 years, but he's now here and he never intends to ever go back to the UK. But this is his entitlement. He worked for 21 years to actually accumulate those benefits. So he should claim it. Otherwise, it's going to be lost forever. He can claim that regardless of whether he's going to be living in India or the UAE, or he retires in France or the States or Canada, where he was discussing. So it makes no difference. Okay, I've got another question here about what if someone's contributions were prior to 2006? Okay, the answer is you can't top up those contributions. So if you have a gap from pre-2006 right now, you won't be able to top up. If you leave it till after 31st of July 2023, if you have a gap from before 2017 tax year, you won't be able to top up that, okay? But right now you can top up back to 2006. Now, bear in mind that do you have to top up? The answer is no. I mean, I would say that if you're not going to go back to the UK and you still have a good amount of working years ahead of you, if you can afford to top up and backdate and do this while you have the opportunity to do it so cost effectively, why not do it? Because then if you get to 35 years, then you can just forget about making any other voluntary contribution again for the rest of your life. However, if you're young and you think that, well, I've got loads of years ahead of me to make up the 35 years, and I may well even go back to the UK and work in the UK, in which case I'm going to have to pay national insurance contributions anyway, then maybe you don't need to backdate all those years. So it's going to be, it depends on the person and their particular scenario. But I think for people that are long-term overseas, this is a once-in-a-lifetime thing that they can get to repurchase the opportunity to get that benefit at such a low cost. Okay. Now, hopefully that's answers some of those questions. We'll continue with the Q&A at the end of the session. Okay. So I just wanted to I wanted to go through this form with you. So let me just kill this question box on my screen. Let me just show you how to go through this briefly. Now, your local Holborn advisor will give you information and guidance on this too. So everyone will get contacted locally, and we'll do follow-up sessions offline with anyone who needs any support. But this is the form that you need to complete. The first part is self-explanatory. It's just about who you are, national insurance number, date of birth, marital status, that sort of thing. The second part is about your absence abroad. Now, it does say what country you're going to, but you use the same form if you're already overseas. So you just put where you are at the moment, your address abroad. Okay, now you can put a UK address if you want to. And I would suggest that if you have one and you're living somewhere like the UAE or Saudi, where there's not a proper, often get lost if they're sent normal post, that you use a UK address for correspondence, or you use your sister's UK address, or any address that you want to give HMRC there to be able to write because they're not going to sort of spend the money on sending any correspondence by courier. And unfortunately, a lot of these documentations, they still do the old-fashioned post way. They don't do them by email or electronically. It's very frustrating. It would be nice if you could just do all of this through the gov.uk portal. Okay. But anyway, now it says, what date did you leave or will you leave the UK? So obviously you'll put that. How long do you intend to stay abroad? Well, if you don't know, just put indefinitely or until retirement or whatever you fancy. Okay. Are you ordinarily resident in the UK? Well, ordinarily resident means that you are tax resident. Now, how do you know this? Well, you'd have to look at your tax residency test. If you don't know your tax residency status, then you can use that, and the links are embedded for the state pension, but they have tools on there to check the statutory residency test, and you can put your information in and see if you'd be classified as resident or non-resident. It used to be that as long as you're outside the UK for 183 days every tax year, then you'd be a non-resident, but that's no longer the case. They changed the rules in 2013, and there's some additional criteria. But as a general rule, if you're living and working outside of the UK, then you're probably not going to be treated as UK tax resident. So, but any questions on that, let us know. And by the way, this national insurance contributions from overseas has got nothing whatsoever with you paying tax in the UK. It's a completely separate matter. So when you're completing this, I'd urge you just to be completely transparent in terms of filling it out. Don't think you've got anything to, to hide or anything. Unless you are somehow deemed as tax resident in the UK, you will not have to pay any tax on your worldwide income. You only have to pay tax on your UK income. Okay. On that point as well, and this I saw as one of the questions about tax on the state pension. You will have to pay tax if you're in the UK on your state total income is more than your annual personal allowance, which is £12,585. Okay, so if you've got your state pension and you've got other income of, let's say, 15,000, 20,000 with a personal allowance, so you'll be paying tax. Okay, if your only income is your state pension, at the moment, that's under the personal allowance. However, if you're not living in the UK, there's a whole load of different tax treaties that you can utilize around the world. And you can actually register yourself as tax resident in the country you're living. And then you can request for your, in this case, the Department of Work and Pensions, or let's say you've got a private pension or an ex-company pension from years ago and you're living overseas, you can complete this process to get that paid by the pension administrators gross, and then it's your responsibility to pay tax in the receiving country, which if you live in the UAE, for instance, or Saudi Arabia, there is no tax on retirement income. So essentially you get your retirement income tax free as long as you're not living in the UK there. Okay, so hopefully that answers that. This bit is self-explanatory. There's a direct debit mandate. If you have a direct debit, if you have a bank account, in the UK still, and you want to pay direct debit, you can do. Here is about your employment. So you'll need to actually put your last employer that you worked with when you were paying national insurances in the UK, or if you're self-employed, you put, the name of your company and that. And when did you last pay it? If you claimed the dole money, you pop that in here. And this is where you put about your employment status abroad. Now, if you're obviously not employed, then you would tick no here and leave this. And you won't be eligible to pay class 3, or sorry, if you're not employed, you would tick no, and you unfortunately, you would not be eligible for class 2 contributions. You'd have to pay the class 3 at £824 a year. Okay, but if you are working and you're employed or self-employed, then you would tick yes, complete the details here. So if your company has a UK company, you can pop it in there. If you're working for some sort of government agency or something, you can pop that in down the bottom here, but that's not applicable for most people. And then here you would tick what you would want to pay. So here, most people would hopefully be ticking the class 2. Obviously, you can tick direct debit if you want, but for most of my expat clients that I've been setting up over the years to do this, we've got everyone on just annual payments, okay? And they'll be given like a code, sort of reference or something that they actually put when they're making their payments, so that the HMRC know that that's their payment for their national insurance contribution. So that's part of the process of getting this up. Now, you also can, if you want to, nominate an agent. So there are certain designations and types of company in the UK that are registered with HMRC as agents. Tax advisors, accountants are probably the most common ones. Okay, so if somebody wants somebody to handle the whole process for them, they can appoint one of these agents to basically act as their proxy. And actually, I've had quite a few people do this because they just haven't got the time to be concerned about this. And it's just a small amount of money they need to pay and have someone just take care of the whole thing for them on their behalf. And that person will do all the chasing and everything else. So what does that usually cost? Most of these types of companies that do this will charge about £300 to £500 per year. Okay, so not per year, £300 to £500. That's it, and for basically doing the process for you up to the point where you're then making your national insurance contributions. You've done your backdating. Now, if you are going to be doing this form, then all you need to do to find out what your shortfall is, in case you can't get hold of your government gateway ID to check your national insurance record, is tick number 7 and put yes. So do you want to know about any shortfall? Everyone should be ticking that. Okay, just in case, so that when the HMRC then receive your application, they'll notify you of the shortfall, and then you'll have the option of when and how much you want to pay. Okay, so that's basically it. And then you have an address. Now, I would strongly urge you to send this to the address here by courier so that you have a record of it being received. We've had a lot of people over the past months attending these webinars that are already somewhere in this process, but they literally cannot reach the HMRC to find out even if the HMRC has received their application in the first place, and they've not heard anything for months. It is an absolute nightmare. There's a huge backlog. It all actually started through COVID era. They've never actually cleared it. We've got applications that we've been helping October time that still haven't heard anything back from HMRC, but we have been told categorically by the agents that we're using in the UK to act as proxies with HMRC, that are, the HMRC registered agents that I was talking about before, that if the application is in, then you're going to be grandfathered across, even if you don't actually end up contribution prior to the rules changing. The fact that you've submitted the application, it's there, is enough. So you having evidence that HMRC have received your application, even if you can't reach them, I think hopefully will give you that confidence that it's work in progress. Then you can just get on with your life, go on about your business, and hopefully, if they start to clear this backlog, then hopefully in a few months' time, you're going to get some notification by post at that address that you put down on here, giving you this information, and you'll move forward. Okay. Let's just check the Q&A again. Okay. Right. Okay. So what we've got another question here to say, if someone stopped contributing in, let's say, 2002, what can they do to claim their proportionate state pension? Well, look, if you act now, you would have the ability to 2006 right the way through to this tax year. Okay. Now, do you need to pay all of those in one go? No. What's at stake right now is the years from 2006 to 2016, and then 2017, 18, 19, 20, 21. 22 you can pay over the next 6 years, well, including this tax year. Okay, so if you want to, you can continue and get your entitlement. Maybe you'll get to 35 years, maybe you won't. It depends how many years you've got left to retirement. But the only years you would lose if you stop contributing in 2002 are the years between 2002 and 2006. So those 4 years are currently what's going to be lost forever. Although after the 31st of July, you'd lose from 2002 through to 2016. Hopefully that's making sense. Any other questions at the moment? There's a question about whether somebody, if they pass on, their state pension goes to their spouse. It doesn't, unfortunately. It's your state pension, so it doesn't. But bear in mind that if you're paying class 2, you only need to out-survive your retirement by 1 year, and you're going to be in the black. So it's still worthwhile doing, I would say. Okay. So we got someone asking about the form here. Andrew is asking, question 18 says about working overseas for an employer. If you have your own company and let's say you're a company director, yes, you can put that. Okay, it's fine. But if you're self-employed, then you could put yourself as self-employed. It makes no difference. You either have to be employed or self-employed. Okay. Now, I've got a question from Sharif saying, can he send a form using the Royal Mail? Well, as I mentioned, I would strongly advise against that. I mean, you can use the recorded delivery service. I don't think it's that reliable. I've lost stuff in that myself very recently. I would recommend that, given the deadline, if this is really going to affect the your entitlement and you need to get your application in, then spend $20-30 on a courier and get the receipt to say that it's been received. That's my advice, but you can of course send it Royal Mail if you want to. Okay. Again, another question: will this affect my child who's applying for UK university fee status? No. Okay, this has got nothing whatsoever to do with that. It's got nothing to do with resident status, tax status, your child's status as an international or resident student. Okay, obviously international university fees are more expensive than if they're treated if they're local. So shouldn't do whatsoever. That would be down to your child. This is to do with your national insurance record only. Okay. Let's just quickly wrap. We're close to the end of. We've actually really gone for 1 hour. I didn't realize we were going on that far. So I just want to wrap point here really, and that is that we find every single day doing our job that it's not only people are not contributions, either because they didn't know about it or because they just disregarded it. But the majority of people that we come into every single day, expats that are working overseas, are not making any type of retirement contributions whatsoever. And what they're finding, of course, is over the years, they'll be overseas for a long time, but eventually they'll start realizing that their friends and family back home, because they're actually being forced through one way or another to contribute towards their retirement, or there's big tax incentives for them to do so, they're actually getting much further ahead, even though they haven't benefited from all this, tax-free or tax-efficient income we get as being an expat. So when you are an expat to save for your retirement, no one else is going to do this for you in most cases. There are many companies now that used to have schemes to help people with retirement, but it's no longer an employee benefit for expats. Even companies like Apple and Amazon, who have got massive employee benefit schemes, they don't have the same type of retirement packages and things like that as they do for their onshore counterparts. And mainly that's because they're not incentivized to do so by the tax authorities. Any tax break on the contributions they're making for their employees. So it really, if you are one of these people that's not saving for your retirement, it really is time to start saving. Okay, no one else is going to do it for you. You're in a unique position. It's a unique position in many cases where you have probably more disposable income than perhaps you might do if you're living in a heavily taxed environment and you have quite high living costs. Okay, but I put here a few tips on what to do to get started. So I would recommend for anyone who's starting, even if they're not, it's not too many years until they retire and they really want to, really plow into it, is just start small and build up. Don't just try and go all in, because you will find it very hard to then develop a habit and a discipline to do it, and it will be something that you resent doing. So just start small and save regularly. Make sure you have flexibility. You are an expat. You're going to have a lot of potential things that you might encounter that maybe you wouldn't encounter. There's not the kind of safety nets in these places that you have back home. We obviously all found that out in COVID times. It was difficult for many, many people. Lots of people had to leave or live on dramatically reduced income without any type of safety net whatsoever from the governments where they were living. So it's important that you do remain flexible, but at the same time, make sure you pay yourself first. Allocate a certain amount of money that you pay as soon as you get paid and set that aside for retirement and forget about it. Plan long term and don't put this off, because the longer you put it off, the more you're going to find that you're going to progress on it, because that's just human nature, unfortunately. So in this presentation, I've actually put some tools that you can use to help you plan your retirement. Obviously, we can help you do that. This is what we do as financial advisors. So all of us would be ready to help you in developing a retirement plan. And bear in mind, a retirement plan in the 21st century is not like, an old-fashioned pension scheme. It can that you've invested into over your lifetime, there's going to be enough to give you a residual income. So that might be your business, it might be property, it could be a portfolio of properties that you've got. It could have got into stocks and bonds that are paying income, but whatever they are, that needs to be enough to be able to support you past retirement. And there are quite a few people that I meet that say, well, I've got no intention of retiring, I'll work till I die and that sort of thing. But the reality is it's not quite so easy as that. Okay, as we get older, we do develop more and more chance of developing health issues, and we might not be able to work. Plus, for most, the career plateau, and once they've reached that, if they happen to lose their job or, they relocate and they try to find a different job, they're never able to get back to that sort of position that they were in before. And after a while, they end up, deciding that's it. They've just not got the motivation they used to have when they were in that plateau position. So the reality is a lot different. And I don't think nowadays people should shy away from the fact that they need to have this in the future. And for most people, it will be probably the single most expensive thing that someone will ever have to fund. So it's worthwhile starting as soon as possible. Now, let's just check if there are any further questions before we wrap up. So we've got, okay, so I have a few different people putting their individual scenarios that are, what I'd like to do is invite these particular individuals to talk to me one-to-one, because I don't want to keep everybody here to discuss these little details, but obviously to you as an individual, these are important. So this is what we'll do. I'll be contacting you and my colleagues wherever you are. If you've had an invitation from one of my colleagues, we'll be contacting you tomorrow, and we will be following up. And anyone who wants to have any question, it can just be a quick telephone Q&A, or it could be a full-on financial planning consultation. It's entirely up to you, but we'll be at your disposal. We can arrange this. All right, so I think we're going to call it a night because we went over our sort of typical timeline. I hope that everyone who attended did find it useful. Thank you so much for joining and sparing me your time, and have a wonderful rest of your morning, afternoon, or evening, whatever it is, where you happen to be in the world. And it's my pleasure to talk to you, and thank you so much. Have a great day ahead.